Hello trade pros. In today's video, we're going to talk about how to pay yourself as a day trader, how to accumulate a certain amount of money that you need for your working capital, and how to pay yourself the excess. We're going to be doing a deep dive in this topic, and it's something that I hope every trader gets to experience. And that's our mission at Trade Pro Academy, is to help you get to this point. Now let's dive right into this video. Before I begin, I want to talk about the biggest mistakes that people actually make when it comes to trading and the account balance that they keep. The biggest mistake, number one, is that people have too little money. Being undercapitalized makes you run into cash flow issues and start to trade from a level of scarcity. This is all about putting yourself in a position that you have to make money, and with a small account balance, even a small loss starts to impact you emotionally. These emotions then compound and turn into losing trades, losing streaks, and ultimately blown accounts. When you have a small cash balance, you engage in fear-based trading. And trading from a standpoint of fear is one of the worst things for you. And it's the surest and quickest ways to blow out your account. Mistake number two, and this is also a really big one. Traders allow themselves to accumulate too much money in their account and they keep too much cash on hand, more than they'll ever need to actually trade their position size. The biggest reason that this is a challenge is that there's an opportunity cost. You could put this capital at work somewhere else, and I'll talk about how I do this, and it actually presents a liability. If you have more money in your account than you need to work with, this creates a liability because on a day where you're doing down, it'll allow you the option to put on so much more risk than you're used to taking with the hopes of coming back. And as we all know, nothing ever comes back. It only takes one serious blowout trade to do significant damage to your account and trading career. So extra money that you won't be using is actually a liability to just keep on your account position. So let's talk about now how to pay yourself. Before you begin paying yourself as a trader, you have to build your capital pool. This is when you start trading with a proven strategy with an edge. When you're being disciplined, patient, and you're surgical with your execution, you start to accumulate profit in your account. However, you eventually will hit a point in your career where you're well capitalized. This means you have enough money for the trading size that you're comfortable doing. This isn't about increasing your trading size to continuously make more, because at the end of the day, increasing your trading size or scaling your account is only required once you're finding success. And then you slowly scale so you don't need extra capital. So as you get in a position where you're earning good money and you're generating returns from your trading activities, you're going to start to accumulate more money than you'll need. The right amount of money in your account is a tool, and it's a necessary capital for doing business. I call this balance my working capital. But how much do you need of working capital for your trading? This really depends on what you're trading, how often you trade, how many products, how many different positions you're in at once, and how many strategies you're funding at the same time. Let's assume you're only trading one strategy in one market. Personally, I trade 10 to 16 lots on a typical basis. So given the market condition and opportunity, it'll be anywhere from 10 to 16, sometimes less. But the maximum I'll tend to go is 16 or so on my position size. And I found that's what I'm comfortable with in my career. I traded bigger before and I had to scale down. So at 16 lots on the futures market, I round that up to 20. I give myself the ability to go an extra couple lots if I need. In my brokerage account, I require $500 of margin, a contract, in order to put on one position on the futures market. That means I need $10,000 of US capital minimum to get myself exposure of 20 contracts. However, you don't want to be in a position where one tick against you is going to sell you out and get you a margin call. So what I do is I 3x the minimum amount required to prevent drawdown shocks. And that means if I have a bad day, it doesn't look bad as a percentage of the total capital I have available as it would if I only kept what was necessary to trade. This is my cushion, and I think it's very important to have a cushion of at least 3 to 4x of what you're typically working with on a daily basis. So that puts me at around $30,000 US. Sometimes, however, when markets get really volatile, margin increases to 15,000 a contract on the S&P 500. This high volatility means that if I only had the 30,000 available, I'd be able to trade 2 contracts at $15,000 margin. However, I like to go anywhere 3 to 4 contracts, even in a higher volatility period. So that puts me at the 45,000 mark. If you do 3 contracts at 15,000 each at the maximum margin at the most volatile position times, you're gonna get to the point where you need about $45,000 to trade that size. Now that's a good cushion. I add another 5 on top because, hey, I'm a sucker for round numbers. And that puts me at a $50,000 account balance in my futures trading account. That's what I consider to be my working capital. And that's what's necessary for me to show up on a daily basis, to trade my strategy, and to trade my style at this stage of my career. It's very important that you take this number and adjust it to yourself, because you don't need 50,000. If you're starting with 1 contract, you could start with 2,000. If you're starting with the micros in the futures market, you could even start with just $500 and still maintain a leeway or a cushion, if you will, and still put yourself in a good position. I recommend $1,000 for every micro that you trade to give yourself comfort and to not have these big drawdown shocks on down days, and about $3,000 to $4,000 per S&P contract that you trade on general, on principle. So by this point in the video, I've explained to you the biggest mistakes that traders make pertaining to capitalizing their account. And we've also talked about how to go ahead and calculate your working capital and adjust it for high volatility periods. Now to the good stuff. How do you pay yourself? And at the end of the day, a lot of this depends on your lifestyle. How often do you need money is the big question. Do you have other income sources? Myself, I have investments in real estate and numerous other income sources where trading isn't my only one. And so if you decide to draw down on those income sources, then you'll have some extra surplus capital that you'll get to invest outside of just day trading. So if you have other income sources, it's a consideration. How much money do I need? What are your expenses like? Do you have a lot of fees to transfer your money out? Because each one of these is gonna determine the frequency at which you pay yourself and how much. Now you can really do any frequency that you want. You could pay yourself daily if you're really interested in that. But while you're making and crystallizing the gains on a daily basis as a day trader, you should pick a period that matches some of your expenditures. If you have expenses on a monthly basis for your mortgage, if you have your bills coming up monthly, if you need money more often, go bi-weekly. But for me, I find that bi-weekly or monthly works best. And it's important that you commit to this frequency, because even if you don't need the money, it's important that you pay yourself so you have the psychology of experiencing taking money out of the market. This keeps you disciplined, concentrated, and focused on treating this like a business because it generates a paycheck for you. It's also important to note that in this business, consistent profitability in your trading account doesn't necessarily turn into consistent income for you. So even though on a daily basis your returns fluctuate and vary, you could set yourself up in a way where you're paying yourself a consistent amount on a bi-weekly or a monthly basis. So here's how you pay yourself. You start by calculating your working capital, number 1. Number 2, decide the frequency at which you want to pay yourself. And number 3 is, on that frequency or on that cycle, you transfer any excess money above and beyond your working capital into your bank account. You could do this through a wire transfer, you could do it through an EFT, and you could also, at some brokerages, do it through a transfer from credit card. But in the futures market, that's not a thing. You need to either wire transfer, ECH, or ETF. Either 3 options give you different fees, and some of them are quicker than others. But if you initiate it a few days before your capital requirement needs, before you want to get paid, you should be able to get paid on time. And once you do this a few times, you'll understand the periods between when you initiate the process and when you actually receive your money. So let's go through an example. Let's say theoretically this month I'm up to 95,000 on my trading account balance. And my working capital, as we calculated together, is 50,000. This would mean that I would need to transfer out $40,000 to the bank account on my selected frequency. And again, you could do it on a bi-weekly basis or on a monthly basis. What is important is that you create a schedule and stick to it so you can once again get the experience of the feel of what it's like to withdraw money from the market and not just put it in an account and risk it on a daily basis. Once you transfer that money to your bank account, you're back down to your working capital, and you can continue to work with that knowing that there's no extra pressure because your working capital is enough for you to sustain any drawdowns in your career. The reality is, as traders, we have down days as well. And if you have a down day, a down week, all of this should be factored into the cushion or the buffer of what is considered your working capital. But it really is that simple. Make a plan for yourself on how you're going to pay yourself, when, how much you expect to do. And at the end of the day, let's make this a business. The reality is, as traders, this is no different than operating a business, and you need to treat it that way. The last thing I want to touch on is, what if you're below your working capital and you want to pay yourself nonetheless because you want to get a consistent paycheck? This is where it gets interesting. So if you're down for an extended period, like a week or two, and your next paycheck, let's use my example, I'm down to $35,000 because I've had some horrendous trading for whatever reason. You have a decision here to make, either to forego that paycheck, which will really enforce the fact that you need to be disciplined to make it back, or to pay yourself but trade smaller as a result. What you need to understand though is that when you start trading smaller than you have been, it's harder to get back those same returns. Even though you're trading the same contract sizes, your balances are going to be lower, and it can really impact you on a psychological level. So that's my advice to you on how to get paid. And it's very simple. Start by calculating your working capital, come up with a payment frequency, and sweep the excess of your working capital into your bank account on a regular basis. And that's how you get paid as a day trader. I hope you've enjoyed this video, and I'd love to hear from you how you're going to implement this. And if you want to share your plan with us, please put it in the comments below, and I'll personally read it and give you some feedback to try and help you out. I appreciate you guys. I hope you've learned a ton. Please don't forget to hit the like button, click the subscribe, and hit the notifications bell to be alerted for any new content. We post daily. That's it for today. Have yourself a great day, manage that risk, and trade like a trade pro. Thank you and goodbye. Hello, and thank you for watching this video. I want to take a moment to invite you to an exclusive online trading masterclass. In this event, you're going to learn 3 key things to help take your trading to the next level. Number 1, we're going to teach you a complete price action strategy used by professional traders on a daily basis, plus give you the checklist so you know how to check off each step to qualify the opportunities. Number 2, we're going to teach you how to use advanced order flow analytics to help you qualify high probability, low risk trade setups on a daily basis. Plus, we're going to teach you how to use that order flow to disqualify the trades that you're used to taking that end up being stopped out. Number 3, we're going to show you how you can apply all of this information with a small account, because you could start small and scale up. In fact, that's the only way to start, and a lot of our traders are doing it in our community on a daily basis. This is an exclusive offer you could get online only at this event. I look forward to seeing you at this masterclass and teaching you these 3 secrets of highly profitable day trading. Take care and have a great day.